So today I want to talk about risk in the context of investing. Now, the conventional wisdom tells you that things like cash and CDs are relatively low risk instruments. There's virtually no chance of a loss. There is a virtually guaranteed chance of some small upside, and things like stock mutual funds and individual stocks are very high risk. Now, the dispersion of returns with these high risk assets are such that you have some negative outcomes. That's why we see some down arrows there on the left side. And on these kind of risk-free assets, there's virtually no downside, but the dispersion is different. So the higher upside, higher downside. Now, what I'm going to argue is that as your time horizon increases, this actually flips and the stock mutual fund becomes one of the more risk-free assets out there, and that cash and CDs become very, very risky indeed. So what I want you first to do is think about absolute returns and relative returns. So if you think about an asset class, it can go up, it can go down versus itself. That's kind of an absolute risk. We can also think about relative risk. So one asset class versus another. Did the stock mutual fund do better or worse than cash? Now, in both cases, what we're going to find as the time horizon increases, the risky assets become less and less risky. Let's go ahead and take a look at a very long time horizon, much more than a typical person would live. This goes back all the way to 1802 through 2015. And we can see here that stocks, the risky asset, clearly dominate all other asset classes. So $1 invested in 1802 grew to over $1 million in 2015, a very long time horizon. The other asset classes on this log scale pale in comparison. There's huge relative risk between being in these other asset classes and being in stocks. Clearly, for a long time horizon, you want to be in stocks. That's where your spending power will be maintained and improve dramatically. These are all real dollars here. We can also look at some shorter time horizons. So over 1 year, you can see that even at a 1 year time period, the S&P 500 in this case, the risky asset has a positive return 73% of the time versus not. So again, it's 1 year, so the dispersion is pretty large. There is some relative risk there. There's a decent chance that a stock would underperform cash, but better often than not, better than a coin toss, stocks would outperform cash. We can see that over 3 years, this improves to 83% of the time. Stocks are doing better than cash. The dispersion comes down. The relative risk is shifting from cash to stocks. In other words, we want to be shifting from cash to stocks. If we go to a 5 year period, it improves even more. 87% of the time, we're better off with stocks. Again, the dispersion is coming down on stocks, and the risk is shifting from the stocks to the cash, relatively speaking. If we go to a 10-year period of time, it becomes even more dramatic. 94% of the time, we're doing better off with stocks than we are with cash. Again, that dispersion is coming down. It's narrowing and it's shifting to the positive side. The risk, relatively speaking, is shifting from the quote unquote risky stocks to the quote unquote risk-free cash. Now, in terms of horizon, that's all we're talking about here. So for short time horizons, cash is risk-free. Stocks are very risky because the dispersion of outcomes is very large. Over long periods of time, cash becomes very, very risky. It does not grow very much. Stocks become low risk. They're never going to be risk-free, but over longer and longer time horizons, it has almost never happened that over a 20-year period of time that stocks have underperformed cash. Over longer time horizons, even more the case. So we again shift the risk from stocks over to cash from over long time horizons. So what I'm trying to get you to do here is change your perspective and think about multiple dimensions. You can think about risk and returns, but you also want to think about your time horizon. Thanks so much for listening. I hope you enjoyed that.